China's Zhongzhi Enterprise Group, a leading wealth manager, has informed investors that it is facing significant insolvency issues, with liabilities amounting to as much as $64 billion. This development has raised concerns that the country's property debt crisis is spreading to the wider financial sector. In a letter to investors, the firm, which has substantial exposure to China's real estate sector, apologized for its financial situation. The letter revealed that Zhongzhi has total liabilities ranging from 420 billion yuan to 460 billion yuan. According to the letter, the firm's estimated total assets are around 200 billion yuan. Zhongzhi, based in Beijing, has not yet responded to requests for comment from Reuters. The worsening situation at Zhongzhi, a major player in China's shadow banking sector, which is roughly the size of the French economy, is expected to raise concerns about contagion. However, some analysts anticipate that regulators will intervene to prevent a broader fallout. China's heavily indebted property sector has been grappling with a liquidity crunch since 2020. Defaults by developers since late 2021 have hindered economic growth and unsettled global markets. Wealth managers linked to shadow banking in China typically operate outside the regulations that govern commercial banks. They primarily direct the proceeds from wealth products sold to retail investors to real estate developers and other sectors. Signs of trouble at the Zhongzhi Group first emerged in July when Zhongrong International Trust Co., a leading trust company controlled by Zhongzhi, failed to make payments on numerous investment products. Su, an investor in a Zhongrong trust product, described the situation as an enormous hole in the company's books. She added that the firm has been in disarray. In the letter, Zhongzhi stated that its assets are concentrated in long-term debt and equity investments, making it challenging to liquidate them and generate returns. The group acknowledged that it is seriously insolvent and faces significant operational risks. It expressed deep apologies for the losses incurred by investors and emphasized the urgency and seriousness of resolving the overall risk. Zhongzhi had engaged one of the Big Four accounting firms to conduct an audit and was seeking strategic investors, as revealed in a video seen by Reuters in August. The underlying assets of Zhongrong Trust are predominantly related to the property sector, which carries high default risks, according to Xing Xiaopeng, senior China strategist at ANZ. He noted that the company is unable to recover funds amid the property woes, resulting in significant discounts to its assets. Zhongzhi, which began with timber and real estate trades in the 1990s, has since expanded into various businesses, including chipmaking, healthcare, new energy vehicles, and finance. Its financial operations encompass trust, asset management, insurance, futures, and wealth management. In recent years, Zhongzhi has been divesting stakes in some of the listed companies it controls and downsizing its business. This was prompted by pressure following China's crackdown on shadow banking and the downturn in the property market. Christopher Better, deputy director of China research at Gapkel Dragonomics, stated that financial regulators are likely to intervene aggressively if Zhongzhi's troubles start to spread. He added that while the trust industry represents only about 5% of the total financial system, problems in this sector are not necessarily life-threatening. Better also noted that the chances of investors receiving full repayment of their investments are minimal. He suggested that officials could potentially compensate retail investors. but doing so would undermine years of efforts to undermine implicit guarantees, so it is unlikely to happen.